Our featured guest today says the Canadian life insurance companies have been subtly outperforming. But of course, the question becomes, can that run continue? Joining us now to discuss is Brandon Merkosky, VP for Portfolio Research with TD Asset Management. Great to have you back on the show. Welcome back.
Yeah, thanks, Greg, for having me on. I think when most people hear life insurance companies like Sun Life and Manulife, they think that that's all they really do. But really, it's so much more that they do. So why have these stocks been outperforming? Yeah, it really comes down to three things: interest rates, capital markets, and employment. So why does employment matter? Well, Sun Life, Manulife, they administer the benefits plans for employers. Think of your vision care, think of your dental care. As more people are working in the economy, that's obviously good for their revenue generation as they're administering larger and larger plans. If we think of capital markets, well, they actually have large asset management businesses as well. This is them helping their customers plan for retirement and also post-retirement too, managing their wealth. When capital markets are doing better, it's easier for them to charge larger fees and ultimately grow their revenues that way as well too. If we think about interest rates, it is a little bit more nuanced in the sense that they take the premiums that they're receiving every single month from customers, whether it be life insurance or whether it be the benefits business, and they invest those premiums into bonds. And when those interest rates are higher, they're able to generate more income for their shareholders.
So we know, obviously, the life cos are interest rate sensitive, as you were laying. The higher interest rates can actually start hurting some of the financial assets they hold?
Yeah, so it's a very important question, and I think it's logical, to think about, higher interest rates bringing down bond values, which these companies are holding bonds on their balance sheet. So, it would be intuitive to assume that it's somewhat negative. But it doesn't really matter to these companies very much because they are holding these bonds to maturity. And then when they're getting new premiums coming in, they're investing them at higher rates. The other way to think about it is in terms of the premium calculation. So this really matters for life insurance companies and has been a major factor over the past 3 years. And so just to deconstruct it a little bit for the viewers here, so if we're to think about how a life insurance premium is calculated, it's the probability that they're going to have to pay out that loss, the costs associated with it, and then you multiply that by the probability, and then there's a third component there that's often forgotten about, and that's the discount rate. So they take that calculated value and divide it by the discount rate. Now the discount rate is set by bond rates, and the longer the yield bond rates are higher in this decade than they have been in the past decade, which means the premiums are lower. Life insurance companies can then use that lower theoretical premium to do one of two things. They can either charge a lower premium and drum up more sales, or they can maintain the premium at old levels and capture more profit.
Okay, so you also talked about the link to employment, that obviously if you have a job and you have benefits, then you're probably dealing with, I think in my household, we deal with all the major life between my wife's work and my work. Yeah. But should investors then be concerned that there's that tight link towards employment if employment goes the other way?
Yeah, I think it is important to emphasize that these companies are pro-cyclical companies. But that doesn't mean that they're necessarily defenseless if employment comes off. So there's two things at play here. First, the business aspect, and then the stock aspect. So for the business aspect, these companies are very well diversified globally across Asia and Europe, and it depends on which company, but they are diversified. And this matters because if there is a hiccup in Canada, whether it be trade orientated or whether it be something else, they have their profitability can be more sustainable than a company that's 100% domestic. The other end of the business aspect is today, because profits have been so good over the last 3 years, they have very robust balance sheets and their capital ratios are well above the minimum regulatory requirements. And then there's also the stock aspect. So from a stock perspective, yes, life insurance companies are pro-cyclical, but their cyclicality is less than banks. So if an investor is looking to get financials exposure, but volatility is increasing a little bit, they may be more interested in life insurance stocks than they would have been in the past.
All right, so the big life cos, they got different levers they can pull in different economic situations. There's things working in their favor. What about some of the risks for the sector?
So I really think there's two key major risks for the sector: capital markets and timing of cash flows. So from the capital markets perspective, their balance sheets are invested in capital markets. So if there's increased volatility in capital markets, that can become an earnings headwind for them. And then and then they also have asset management businesses, which as those experience potentially lower asset values, they won't be able to charge as high fees as they would have in the past. And so that can also be an earnings headwind. In terms of the cash flow timing, we have to think back to what these life insurance companies do with their premiums. They go and invest them. And yes, as I mentioned earlier, they invest them in bonds, but they also invest them in real estate companies too. This exposes them to both credit risk and potential vacancies in real estate. So if either of those tick up, that can create mismatches in timing of cash flows to meet their liabilities. And so then they have to go and sell different assets that are maybe less volatile to cover those liabilities with negative financial implications.
Now, since the beginning of the year, different pockets of the market have taken their turn being the ones that are going to get disrupted by AI. The share prices get hammered as a result. What about the life cos, the insurers, financial services? What's the AI story here?
Yeah. I think overall AI can be quite positive for insurance companies, but the degree at which it is positive very much depends on the type of insurance policies that you're writing. So if it is a longer duration policy, like life insurance or like annuities, I think it's more positive than the rest of insurance. And so the reason for that is because when these companies are setting their premiums, they're basing it off of the cost expenses as they see them today. And their major inputs to the cost today are labor and back office processes, totally ripe for AI to come in and save them money. So they've priced this 15-year policy on expenses today that will be lower over time. And as AI gets implemented, they can capture that difference and have more profits over time.
All right, interesting stuff. We put it all together. What's the longer-term outlook for these companies?
Yeah, I think if we look a little bit past the noise, I think that these companies are very well positioned in terms of technological shift, aging demographics, and approaching newer underpenetrated insurance markets like what we observe in Asia. If we think about, over time, we're getting older, we're going to need more comprehensive solutions for our wealth and our health. And life insurance companies are actively working on those solutions today.